The fact that a passive, set it and forget it, buy and hold, blanket allocation to the stock market is one of the most widely accepted, constantly parroted mainstream recommendations is insane, given how risky it is in reality. How about we dive into the weeds of just one of the many better alternatives? Coming up. Welcome back to some of the smartest, most curious financial minds searching YouTube. You are willing to challenge the status quo in an effort to better your financial future. It's not easy to challenge the traditional paradigm, the traditional way of doing things. So, well done. I can't wait to get to know you better and help however I can. Now, once you come to terms with the obvious reality that the stock market does not always have to go up, then you start to realize just how risky the mainstream recommendations are. You realize it is absolutely possible for the market to have, for example, a negative average annual return over the decades leading up to your retirement, or a 0% average return throughout your entire retired life, however long that might last with those abysmal returns. Certainly higher returns are possible, but those returns I just cited, or worse, are undeniably possible as well. And if you don't understand that yet, don't go complain in the comments. Go watch this thorough breakdown of this reality that we put together for you over here, or go read Myth 10 in my book. But what I want to share with you here is how it is possible to invest in the stock market, because we still do want to take advantage of that significant upside potential, and yet reduce our exposure to that significant downside risk. That's the natural next question after understanding how dangerous that passive strategy is. And it's not with bonds. To understand why that's problematic, just look at 2022 or Myth 9, which was even published before 2022. Now, even though history is not a perfect indicator of what will happen in the future, we can still certainly learn a lot from it in order to build out our better stock market strategies moving forward. We live in Tornado Alley. In fact, several members of my family were in the Joplin, Missouri Pizza Hut on the evening of May 22nd, 2011. They were instructed to evacuate or get in the freezer. Fortunately, they chose the former, as everyone who stayed was tragically killed, along with more than 100 others in that city that night. We don't know exactly when a tornado will form, touch down, and cause devastation. But we have learned to identify patterns that form in the weather that indicate to us an increased likelihood that a twister might wreak some havoc. When weathermen see these patterns emerge, they issue warnings to let us know. And honestly, sadly, unless a tornado has very recently caused devastation near them, most people tend to ignore those warnings. They happen so rarely, especially the really bad ones, that people forget just how devastating they have the potential to be. The financial devastation that can be caused to passive investors in the stock market is similar, in that most people who are exposed to the associated risks have had no immediate experience as to what that devastation can actually be like, to what it would actually feel like. Their advisors, some with the largest, most reputable brokerage firms in the world, tell them that all they have to do is just stay the course and put their blinders on. But neither they nor their advisors have any idea how painful it would be to watch the stock portion of their portfolio, their life savings, drop by nearly 90%, as stock market investors did in 1929. It's not easy, nor would I say advisable, to sit back and watch your $1 million retirement account that you worked so hard for drop almost all the way down to a mere $100,000. How much would your life change? It's not surprising why so many committed suicide after that time. The finance gurus on YouTube tell you that time in the market is all that matters, and to just put your head in the sand and as you save for and into retirement. But you nor they understand how painful an experience it would be to watch your accounts roller coaster up then down, up then down, up then down, but mostly down for 20 years, as Japanese investors who followed this mainstream advice had to suffer through when their market peaked in 1989 and fell for 2 decades, ultimately dropping 80%. And probably the biggest reason why you should certainly not sit back and watch your money vanish into thin air during those times is because there is no reason that the next time or some crash at some point in the future could not be worse. That is absolutely a possibility. But what if, like those weathermen, keeping an eye out for when weather conditions are conducive to tornadoes, we are able to study the past movements in various aspects of the way the stock market has moved in the past prior to massive crashes and identify patterns that might suggest a high likelihood of impending chaos. If you knew that, say, 70% of the time, when the market moved in the way that it moved over the last week, that 70% of those times it proceeded to fall by another, say, 10% or more over the coming 2 weeks, and that the other 30% of the time that it didn't fall by that much, it either fell by less or at best went up, say, 2%. Would you rather your money be invested in a low-cost stock market ETF over the next 2 weeks, given that information? Or, now hear me out, if you had all that information, would you just maybe rather it be moved into cash or something else that wasn't showing a forecast of potential chaos? Maybe? Seriously, what would you prefer? Because it seems obvious to me that if I had that information, I would want my money in something safer, at least during that time. I certainly want that for my clients as well. At the same time, from how they act, it seems to me that even if you had all of that information and presented the scenario to an advisor, they would rather you keep your money in the market. At least that's what they would say, but perhaps because that's how they make their money, or because that advice is easier. It's certainly way less work than trying to identify those patterns and keep up with all of that. Regardless of the reason, it seems that those advisors would rather you just stay in that low-cost ETF. But what would you want? And I know those advisors and other financial gurus who have, staked their careers on this advice, of course, instinctively, they would likely call BS here. You might also think I'm talking about some sort of voodoo. I get it. That's the mainstream narrative. That's what we are preached from every angle. It is certainly easier to sell the idea of just sitting back and not paying attention to what the market's doing. But that doesn't mean it's right. And I'll get to some examples here in a second, bear with me. But assuming it's not some sort of voodoo, and these patterns do exist, let me know in the comments, what would you want to do with your hard-earned money here, with that historic 70% probability of a 10% or greater decline over the coming weeks? Would you rather stay in your ETF and not touch it, or move into something safer, even if just for that 2-week period? Patterns like this absolutely exist. They're not necessarily easy to identify. They don't necessarily hold up forever, but it definitely stands to reason that patterns would emerge. Movements in the market are pretty much just insight into how the masses, how investors as a whole are moving in and out, how they're investing, where they're putting their money, how they feel about various markets. It's not just a bunch of randomized numbers we're talking about. There are people and emotions and institutions behind the market's movements. So it makes sense that patterns, especially prior to times of chaos and increased volatility, would arise. And much like those in the weather, they are not perfect indicators. But does that mean we should ignore them? No. We can learn from them, or at least pay attention to them if they're setting off some alarm bells, so we can figure out how to best prepare ourselves given the information we have. I'm a big fan for my clients and selfishly for my own investments of risk reduction, especially when I can do that without sacrificing gains. I personally do that, again, for myself and my clients, through an enhanced intelligent diversification, as in not just diversifying into other random asset classes that the investor may or may not understand, as is traditionally recommended, but rather very intentionally investing in several different types of investments that will respond in different ways to different circumstances that might come up in the future. We'll touch on that a whole lot in future videos. But when it comes to my market-based investments, my goal is to do everything I can to reduce my market portfolio's maximum drawdown. That is the amount my stock account falls from its high to a bottom. I talk about the significance of this to your long-term returns extensively in my book and then in this video right here. But it's really just math. As your portfolio declines by 50% from the top, you need a 100% gain just to break even. But if your portfolio only falls by 25%, you only need a 33% gain to get back to where you were. And with that 90% drop we talked about earlier, you're not getting back to even until you realize a 900% gain. Good luck. All that to say that if I can analyze historical movements in various aspects of the market and identify patterns that preceded chaos, I will absolutely personally use them in an attempt to avoid those significant drops. And I would think you would want to as well. I understand you want examples. I do too. When I'm doing this for clients and myself, I work with research partners who this is what they spend 100% of their time doing. They pore over troves of historical data, trying to find the best indications of what might happen in the future based on what led up to crashes in the past. They're looking at multiple data points over various time horizons, trying to identify potential warning signs. Many of these systems are so-called black boxes. Much like when a pharmaceutical research team finally creates a breakthrough cure, they want to be able to be compensated for all the time and effort that went into making their drug a reality. Similarly, the researchers who successfully identify these market patterns understandably do not want to share the exact methodologies they're using because, of course, they expended a lot of time and effort to develop them. Discovering these patterns is their job, after all. But fortunately for us, just like expired patents, there are many of these pattern strategies that are in the public domain, so to speak. Here's one that was originally created by a man named Nelson Freeberg. His system uses a point-based approach that follows the moving averages of 5 data points: the S&P 500 index, the Dow Jones Transportation Index, the Dow Jones Utility Index, the Dow Jones Corporate Bond Index, and the NYSE Advanced Decline Line. We could spend a lot of time going into each of these, explaining what each of these is and why it makes sense to track them, but I think that's beyond the scope or even the point of this video. I'm assuming most of you who are still watching are just looking for proof or some sort of evidence or indication that this idea of historical patterns being used to indicate higher probabilities of chaos is not just snake oil. So, simplistically, this system is just assigning 1 point for each index that is above its long-term moving average. If all 5 of those data points are above their long-term average, so 5 points, and the system is not currently in the market, it will move into the market the next day. If the system only has 3 or fewer, then the system will move us out of the market on the following day. This strategy was published in 1995. It wasn't just recently created or something. And it's done extremely well at the goal of minimizing one's exposure to downside risk. From 1980 through partway through 2023, the maximum drawdown of the S&P 500 was more than 55%, which of course happened after the 07-08 crash. A drop that would have been very difficult for an investor to handle in real life, especially one approaching or in retirement. And again, I don't think they should just sit back and watch that happen because of course there's no logical reason why it couldn't have been worse than that 55% decline or have taken longer to recover than it did. But moving on, the worst drawdown within this system over that same period was less than half that decline, a drop of only roughly 23%. Now, outperformance is not the goal necessarily of this particular strategy. Instead, its goal is minimizing the drawdown. But because it is easier to realize higher returns when you do avoid those massive drops, that math we talked about earlier, this strategy has actually been able to edge out the market over those 43 years. It beat the S&P 500, barely. In all, it effectively realized the same return as the market with significantly less exposure to downside risk. And that last part is the goal. There are other strategies that we use alongside these that are instead geared towards capitalizing on patterns that we've noticed form before periods of significant gains. These tend to be more short-term in nature. One example of this, used by one of the research partners that we've partnered with, is based on the observation that when there are short bursts of trading volume on the New York Stock Exchange, that is typically, historically, followed by a further jump in the value of the underlying market. The exact formula they use based on their research is that when the NYSE up volume divided by the down volume is greater than 9, twice in the last 10 days, they will buy into that market and hold it for 15 days and then exit. That's it. It's simple. It doesn't happen that often. So obviously, just using this system by itself would be a little silly as a standalone strategy, but historically, when paired with an underlying system, like the one we just covered, it's led to boosting returns even further. And that's why this is what researchers like this do. They'll use hundreds of these patterns. They look for more patterns, better patterns. They're trying to glean as much information as they can from the way that markets have moved in the past. They're unlike many financial professionals today who obstinately refuse to accept the reality that even though the US market has always historically moved up, that is obviously not a guarantee of what the market has to do in the future. These tactical asset manager research partners that we and others use incorporate hundreds of these types of strategies to help protect ourselves and our clients from significant drops in the market, and to hopefully still be able to outperform the market, even if it does continue its upward trend throughout your entire lifetime. People are different as far as to how much risk they should be exposed. Unfortunately, the mainstream buy and hold stock and bond only approach actually leaves investors exposed to far more risk than I am comfortable with. And I'm a pretty aggressive investor. So when the Weatherman tells you that there's a high probability of chaos on the horizon, I hope you listen and do what you can to protect yourself. And when you open yourself up to the reality that rules-based investing and tactical asset allocation could provide you with better protection for your hard-earned life savings, I hope you'll open yourself up to those financial warning patterns as well, so that you can minimize your exposure to the market's significant downside risk. I admit, it's certainly harder to find a financial weatherman you can trust with important things like this. Heck, it's taken me years to sift through dozens upon dozens of potential research partners for my firm, only to settle on a few in which I have the confidence to invest my and my mother's and my clients' money. And I never stopped that search, by the way. I wish you all the best in finding a financial weatherman like that you can trust. And if you ever want to see all the ways that we help our clients, check out our website to learn more, spicercapital.com. After that, if you think we're a good fit for each other, schedule a time for us to chat. Whatever you do, I wish you all the best.